Hello, I'm Stephen Hunt, and welcome to Dodging Bullets, the Insolvency Practitioners Guide to Surviving the Week. In 2019, we had an idea for a seminar. We did sit down with other insolvency practitioners and discuss the real challenges that we face in our day-to-day work, be they criminal, civil, regulatory, financial. We discussed them all, and it came out with some fascinating conclusions. We tried a couple more, even having online seminars during COVID. More recently, we have been holding the insolvency debate, discussions between insolvency practitioners, lawyers, and other stakeholders in insolvency. And those take place at various venues around the country. We're going to kick off with the topic of how do IPs get their work? With me, I've got a number of guests. If you want to introduce yourself, starting with Frank.
Hi, I'm Frank Turnbull. I'm an insolvency partner.
Hi, I'm Jo Wilson. I've been in the insolvency industry for almost 40 years.
Hello, I'm Jane Stevenson. I'm an ex-city lawyer and now working in insolvency.
And I'm Andrew Goodson. I'm a qualified and licensed insolvency practitioner.
Excellent. Well, I was going to start with something, a sort of bit of a historical footnote. I've got with me the autobiography of Sir Kenneth Cork, published in 1988. Sir Kenneth Cork was known as Mr. Insolvency in the 70s, and in many ways as the godfather of the current insolvency system, being responsible for the Cork Report in the early 80s. I wanted to read a brief passage from his experience of insolvency IPs getting work in the 1950s. He talks about how there were certain shifty practices which were mainstream in the profession, and he felt that when he was joining the profession, he was under pressure to follow those rules. He says, and let me just find the passage, there seemed to be that when a company became insolvent, it called a meeting of representatives of all those who were owed money. Before the meeting took place, those representatives told each other how many creditors they acted for, and then they agreed at the meeting who they would formally appoint as liquidator. That person was normally the one who was owed the largest sum. Then that liquidator would share his fees amongst the others who were supporting him. Cork Gully were threatened that, unless they were prepared to participate in an arrangement of this kind, those who were would combine against us and make sure that we got no more work. So, that's the 1950s. We come to 2026. Has it got any better? Does anyone want to start and talk about how we get our work and what the current market is now? It certainly seems better from my experience.
I think with firms offering very cheap liquidations, I question, does it actually mean that they fall short on the investigations? And if insolvency becomes painless for directors, what incentive remains to act responsibly before failure?
I would take a step back from that because I think that we need to recognise the different ways in which this work is now being shared around and communicated. So frequently the engagement would be with creditors who have a vested interest, or it might be with directors who are seeking advice. And of course, those different parties will have different motivations and be looking for different potential outcomes. And what you might find is some parties servicing one particular side of the industry versus the other side of the industry. The real question is how within that can one firm meet all of those objectives? Frequently they talk about whether things are director-led or whether they're creditor-led. There's a presumption of almost conflict arising between those two positions, and the insolvency practitioner sits in the middle and is supposed to be objective in both their advice but also their proposed strategy which they're trying to implement. And at the same time they're trying to do it for a fee, because they're providing professional advice and they need to make sure that they are paid appropriately. They are therefore trying to work out how to tailor that fee in a way that is most appealing to whichever party they're speaking to. And those different parties will view things differently. The director will view it in a sort of pounds, shillings and pence approach, whereas the creditor will look at it in terms of return and other outcomes.
Back to Sir Kenneth Cork. I mean, I'm just trying to work out in my head halfway between when he was referring to and now was roughly probably when I started insolvency. So I'm just putting out there that I'm very old. When I started in insolvency in the 90s, CVLs, creditors voluntary liquidations, mostly came from accountants. That was the market. It was most small firms certainly were wooing accountants and getting them to refer their clients to the IP. Is that still the case? Do you still feel your collective experience that accountants are still the major source of CVLs now? How much has it changed?
I haven't seen that much referral work by accountants, but that does not mean that accountants make up the majority of the referral work. And I looked with interest on some of the R3 reports and inquiries last year, which were published last year, on fees and the structure of CVLs. And interestingly, very little was made of the referrals and how that work came through. So I don't think there's a clear indication on whether accountants do refer it. Presumably they do refer through all of the MVL work and a reasonable amount of the CVL work, but because creditors will always hold sway, albeit they might originate the work, they may not hold much control beyond that point. Joe, I'm going to defer to you on this one because I think you've had far more engagement with accountants than I have. I've certainly had more engagement with lenders across the board. What's your view on accountants at the moment and whether the market is, as it always has been, accountant-led?
I think it's changed completely. I would guess the majority doesn't come from accountants. It comes from directors direct, and I think they do their own research into what the firm is like, and also the fee plays a big part in it.
I think I'd agree with that. My experience is certainly looking online, there are a multitude of websites out there directed at directors. They seem to be either unlicensed insolvency advisors, saying that they know insolvency practitioners, and the more scurrilous ones say, we act for you, not your creditors. Don't talk to IPs at first instance, talk to us, and we'll advise you about what to tell the insolvency practitioner. That may be a whole debate in itself. But certainly that issue has become obscured by licensed insolvency practitioner firms themselves setting up multiple websites and not using their branding in such a way that they can almost not conceal, but slightly mimic those unlicensed websites to attract the new work. Has anyone got any experience of that?
I've certainly come across websites, and I suppose we ought to do this without directing people specifically to those websites, although maybe we should do a separate post outside of this that does name and shame some of the areas where there appears to be questionable advice.
I think you'll find I've already done that on LinkedIn.
Yes.
I think
yes.
it's a service that I provide from time to time.
Maybe what we need to do is we need to summarize all of Steve's LinkedIn posts which deal with this particular subject matter and make them available as a ready compendium for people to be able to go in and look at.
But it is a useful technique, put it that way. The best way to criticize somebody is merely quote what they've said on their own website and say nothing further. The ridiculous nature of some of the comments sort themselves out, and it has proven to be useful as a way of moving some comments out of the market, such as we act for you, not your creditors. To be fair, that doesn't appear on IP sites. But yeah, the concept, sorry, come back to your point, Frank, the concept of not being proud about your brand. What is it about your own brand that would lead an insolvency practitioner to minimize their brand and put out a generic website to get this sort of work in? What are we saying about how IPs get their work in?
I wonder whether the different brands might be down to different targets of that website. I remember particularly there was a large amount of this took place in what must have been the mid-noughties, as we call them now, the mid-2000s, where a number of, particularly the larger firms, would create a different website aimed at people who might need an IVA. So where they might be scared by the all singing, all dancing insolvency practitioner website that tells you all about administrations and dealing with the official receiver and what have you, where really all they worried about is what happens with my debt, what happens with my house. And so then they created those simpler websites for them. And I wonder whether there is an element of that, which is there's certain types of work, for example, directors that might come in, directors choosing the IP as opposed to a wider website where you're trying to look far more professional when trying to attract accounting firms and the like to refer you work.
Yeah, it does. It just strikes me, particularly national firms spending so much time on branding and presence and offices and things like that, to then walk away from them. Does it suggest the brand wrong? I'm not disagreeing with you, but I'm just it slightly flummoxes me why that would work.
But I do have a couple of different views on this, because it was interesting talking about CVLs, which are, I think, generally what for insolvency practitioners by quantity, the larger amount of the work that's done, but whether they are truly the larger amount of work that's done by way of fees earned, one can't help but think that getting a significant large administration, particularly for the larger firms, would probably net them more money. I mean, stories are myriad of Lehman Brothers and the billing there being £1 billion. And so pushing for that is perhaps a different aim, rather than pushing for directors who are looking just to close down their company, which might be on the border of insolvency as to whether it goes into a members voluntary liquidation or a CVL. And there again, some directors might feel that, for example, PwC is a little bit expensive or will be expensive for them, but a smaller, more high street sounding name is one that they feel they will get a better value for what they want to pay from.
Well, that sort of moves you on to one of the aspects of any customer looking to purchase a product or engage a professional is price. How do we feel that IPs compete on price? Certainly when I've been in conferences talking to IPs in the bar, some of them have views about some of their competitors nearby who seem to be undercutting the market rate, as sort of a driving to the bottom, as it were, getting cheaper and cheaper, or misquoting. There seems to be quite a lot of grumbling about that. I don't know if you've got any experiences similarly, but that seems to be something that really a lot of IPs were quite upset about.
It may not be a thing about price, but certainly it's a thing about value, where if you have someone complaining about someone else charging more, there's a question within that, which is about efficiency. And fundamentally, whoever's paying the bill, do they think they are getting value for money? And how are these figures arrived at? I don't want to take the conversation off towards the CVL fee review, but the suggestion of £10,000 as being a flat fee for CVLs, well, that was the median figure from all the cases reviewed, was £10,000. So how do you say that that's the right fee or the wrong fee for the work being done? And if analogously you were to look at the fees undertaken by other professional services firms like lawyers, you'd expect a degree of transparency on the work being undertaken and the benefit given by that. So there are two things, one of which is how do the IPs view their fees in their own context, with their own business, with their own profit margins, but entirely separately, do they think that they can get away with charging those fees when the competitors might be more efficient, or which could be a bad thing, of course.
Coming in as a lawyer, there are obviously massive similarities in professional services across insolvency and the legal profession. And I think it's interesting about fixed fees. Lawyers obviously have offerings of fixed fees in sort of conveyancing and that kind of thing, where fee generation is by volume and it's done by sort of, say, one fee earner with lots of administrative staff who are doing the non-contentious stuff. And I think there's absolute comparison there with the insolvency practitioners who charge a standard, say, 10 grand fee. But it doesn't really work, as you say, for the more complex matters or the ones that become protracted. I think there's a danger, isn't there?
Is the CVL market, though, going towards sort of the IVA factory territory? I think that, that's how it appears now. That's what happened with the IVAs. There were websites that were put online with tacky sort of incentives, get rid of your debts and things like that. And I think the CVL market is heading that way.
Well, that's a great point, Joe. The major difference and the problem with that, of course, is directors are fiduciaries. In some ways, so are accountants, but they don't seem to realise half the time. But the directors should be shopping for someone to investigate themselves. And in terms of price, are they really paying? I mean, they may be if there's no money. but in the main, the creditors are paying. So you have this very absurd market, maybe something that Jane hasn't seen as a lawyer, but these are fiduciaries looking for liquidators to A, investigate them, B, have it done out of the assets, which they've got no real interest. So it's vulnerable to perverse incentives, finding the liquidator who's least likely to sue them, for example, which may or may not be the official receiver, one for another time. But the question is how does that market work? Even if it was functioning properly, it's very difficult for a fiduciary to be genuinely and purely acting as a fiduciary when they're sitting on a major loss and they could feel responsible for it, and they're shopping in a market where they've got lots of dazzling websites which don't give them any information except warm assurances as to it's all going to be handled smoothly. A comment that was quite interesting from someone I spoke to possibly online a few months ago was they were looking at liquidations being too cheap. And his reaction was, if you see a liquidation too cheap, the reason for that is they're bound to sue you for your director's loan account. And they were going to make fees post-appointment, which is worth unpacking because, of course, one, that's what they should be doing. But in the mind of the person who said it, that sort of created a presumption that what you want to find is a liquidator who charges enough but doesn't pursue you for the DLA. And I don't know if such a market exists, surely not. But yeah, how in the context of just that, how do you market properly to people who aren't generally going to receive your service? They're going to receive the sticky end of your service, as it were, if you do it right.
In a way, you're choosing the person who's about to, practice surgery on you. You're deciding who you want to come in and perform a forensic assessment of your own business and tell you how terrible you were as a director because it's now all gone horribly wrong. I'm being a little bit flippant about that, but I do think you're right. It's a personality thing, and that personality thing can simply be, who do directors feel more comfortable with? Do they trust their professionalism? Is it geographically convenience? Is there a social link there which ought to be disclosed in any sort of onboarding paperwork as a conflict but might be overlooked, versus do they think, if they have done something untoward, that they might either get an easy ride or they've had a referral and recommendation of a particular IP as someone who will either look the other way or won't be resourced to look in any particular detail, and certainly for a particular price won't ask too many questions, and will certainly tick all the boxes in terms of a conduct return, and will cast their eye over the accounts and the bank statements, but won't necessarily go any further than that.
One of my thoughts on the price and whether it can be too low, an immediate small first point is, it's interesting that person assumes there always is a director's loan account, and that there might not be an overdrawn director's loan account for anyone to worry about. But the second point is, I get the feeling that for certainly some firms, for want of a better phrase, bog standard CVL, what some might more dismissively refer to as a burial, is often something that's offered to clients of accountants, particularly back when accountants were a greater source of work, not for that work, but for in case something good would come along. I have experience from a former practice where there was a small firm of local accountants, had many small clients. None of the bills from that work was large, £3,000 to £5,000, if that. And then suddenly one day they walked in and said, "Hi, one of my clients is in financial trouble. I think it might need to go into administration." And the administration resulted in a 7-figure bill for that firm. And so I think that's kind of the dream outcome for some insolvency practices, where they are trying to keep a book of accountants, just in case, it's not for the day-to-day work, which is almost keeping their staff sharp and well practiced in what they're doing. It's because they're hoping that at some point that accountant might have a much larger job, and probably does have medium jobs from time to time, and that's their aim, their hope is to get that work.
That's interesting because that contrasts a little bit with the factory idea, which is people who can promote this sort of work but can do it with such low overheads and very modest profit anticipations. I recall a conversation with a former colleague who had ended up somewhere where some of the CVL paperwork preparation was outsourced to students. entirely numerate, very capable students who worked in their bedroom at night and did things for whatever the minimum wage would be, I imagine, for people at the age of sort of between 16 and 18. And the paperwork was prepared there. It was entirely consistent with remote working at the moment. The quality of the work was consistent. There were lots of referrals coming through, and it meant they could get away with putting CVLs out with fees of, say, £2,000 to £3,000. It's not clear from that whether any of those cases would have had claims if you reviewed them and took a cynical view, or whether it was simply the most cost-effective way of getting to that particular end. And I would argue that a school child in a bedroom is going to be replaced by AI fairly quickly, particularly if you can pull the data from accounting software, from banking software. A lot of it could be automatically generated and circulated. And then the real question is, what value does the human element add to the whole process?
Well, I was going to mention AI because we should take into account the deflationary pressure, the downward pricing of the cost of AI is intended to make these products cheaper. There's at least 2 or 3 IPs I can think of who have subcontracted a lot of their work abroad. And they've explained how cheap the wages are and what they need to do to control the work. I share Joe's view, really, that there's a risk that it descends into the IVA market and essentially ceases to be insolvency at all, and that just can't be right. It's the work getting bit. It's the pre-appointment work. It's the statement of affairs type work, which is dumbing down, it feels. And the loss of the creditors meeting is also affecting that. It's becoming much more procedurally led. But once it's in liquidation, it's a liquidation with all the duties and risks and requirements and disqualification duties, for example, that you expect, which is not like an IVA. Post-appointment IVAs should be very procedural and simple, and the role of a supervisor is very minimal. That's not a liquidation. So it shouldn't be allowed to descend into that. Joe, what do you think?
Well, I think going back to your point about where the work comes from and accountants, I mean, you would see in the 90s, you would always see a statement of affairs fee being paid to an accountant on reports. And I think that the accountants were keen to pass as much as they could through to the IP because they would get payment in return. And obviously that can't happen. I wonder if that's affected how much work IPs are getting from accountants over the years.
Yes, I imagine with social media, it's a more competitive market. Before you ring somebody locally or look in yellow pages, social media, and that gives you more choices. So you would expect competition on price. Kickbacks to the accountants, I agree. There was a sort of legitimate argument for assistance in the preparation of statement of affairs is part of the upfront fee of a CVL, but that was certainly abused by many firms. Interestingly, I think some IPs had disciplinaries relating to the payment of that, but I don't recall a single accountant being punished for soliciting payment, unless anyone can find it online. I think that's right. I don't think there's ever been a reported case of the accountants being put in a similar position. I've certainly seen post-appointment fee kickbacks, some of them quite large sums. Some of them, I think I've seen fees of like 25% of the post-appointment fees being paid back to the referrer in insolvency, and that's in the last year or 2 or 3. So it's still around in the market, that sort of kickback that Sir Kenneth Cork was sort of describing. I'm trying to say where the point goes, really. I suppose my point is that, with fees reducing, the ability to kick back is reducing, but it pushes it into new areas. Are the people receiving the kickback? I think the rise of the independent websites have effectively avoided the kickback because they're taking the money for themselves. And that creates a new issue for the insolvency practitioner, which is one of improper solicitation. The rules on improper solicitation are quite different from corrupt inducement. Corrupt inducement is the criminal offence of paying a bribe to receive an insolvency. Improper solicitation is a much looser civil remedy. Anything improper can be literally anything regulatory, civil, criminal, or just man on the Clapham omnibus improper. And solicitation is not misrepresentation. It could be anything. It could be something on your website, even if it's not relied upon. But the punishment for improper solicitation is the court may order you receive no fee. So having got the job and done all the work perfectly legitimately, you can end up with nothing as by way of a fee. And the problem for insolvency practitioners is it can be not just by the IP, but anyone in the chain that leads to their appointment. So what that opens up in the current market is the risk that a unlicensed insolvency advisor says something deeply improper, such as "we won't pursue your DLA," and then refers the job to a insolvency practitioner. No money changes hands between them two. They're paid directly by the director. But the problem sounds like it will be still visited on the IP because that's how they got their appointment. So you do have to police the chain and lead to your appointment, and that chain is much longer.
Are there many cases, Steve, reported cases on improper solicitation?
Almost none. It has been used and settled. It has been explored in a number of different forums, but in my experience, not a single case has got to court. But it could be used as part of the regulatory process. There's also no definition of who should make an application under it. There doesn't seem to be, the locus is limited to shareholders and creditors. So the regulator can make an application if they find, for example, that someone takes on a job which was subject, they should not have taken on because it was a conflict. By holding out that you have no conflict, that would be improper solicitation of the work. So the regulator can apply to have the fee expunged. So it's quite a powerful weapon. And it's almost interesting that it hasn't been used, rather than looking for the cases that report that it has.
Going on to a different subject, the investigation side of these CVLs. So in what I would call a CVL factory, but, where they do multiple CVLs, what are the level of investigations? The report says no evidence of misconduct, but there's no explanation of what they've actually done to determine that. Are they relying on what the directors said? There's no way of monitoring how much they've looked into, whether there could possibly be any claims.
Well, that's regulation. I remember talking to late departed Des Flynn, head of the Insolvency Service, many years ago, and he bluntly put it to me that you can't look at legislation on the basis of people not following it. You've got to assume that the legislation's in place for it to be met, and you've got to assume the regulation is being followed and the regulators are applying it properly. And I think that was a fair comment. It did sort of put me in my place, as only Des could. And it was very useful. It was very useful to think about what you can and cannot affect. So I would have said, yes, you've got to assume that these jobs that are being taken on cheaply, the regulators are still enforcing. And I think there's evidence of that. The regulations have tightened, the SIPs have tightened. There is some evidence of disciplinary for failing to report certain things, bounce back loans and things like that. So I think we've got some evidence that that's not a market factor.
But I would say some of the investigation aspects, particularly looking at CVLs, are driven by SIP2 requirements and all focus on the submission of a conduct return. And we know that the triage system of conduct returns has slimmed down to make it less comprehensive in what you find. So it becomes a little bit easier for someone to tick all the boxes of saying they've complied with what the regulatory expectations are, but at the same time not do much other than to carry out a very cursory review of what the documents are. And I would also then suggest thinking a little bit about the staffing and resourcing of firms and the work that's being undertaken, how records are looked at and how information is looked at very much depends on the skills and experience of the staff. So in a scenario where you are trying to ensure that you're getting maximum efficiency and speed and value for money in all of this, it may be that the parties looking at it aren't necessarily the ones who would have the experience to carry out the inquiries. So in looking at the time incurred in a SIP9 report, you might see a good 10, 15 hours spent actually investigating. It may not represent 10 or 15 hours worth of thinking or quality consideration.
I think that's fair. I mean, we are, coming back to the earlier point, directors are shopping for people to investigate themselves, which is the exact opposite of the concept of Fielding v. Seary, 2004, I think. So whilst the creditors do select the liquidator notionally, In practice, it's done with a debt due to the director or apathy, I suppose. The director's nomination as liquidator comes in. And it's a tricky, absurd market, really, surely, you've got to sort of make them a coffee and smile and take their money off them and then turn around and sue them. Aren't we in a bit of a nonsense profession? It's duplicitous if you do it right.
I don't think you can win either way, because fundamentally you're guiding someone through a terrible time of their life if they have a strong emotional vested interest in their business and if it has failed, versus guiding someone through yet another business failure if they're cynical and hardened and if they have a very bad track record for running companies. So you get this broad range, and the IP is sitting in the middle of there, trying to be all things to all people, which I think is why you do get divergence within the market for people who feel more comfortable with particular kinds of work and particular approaches. It is impossible to be a thorough generalist in this particular sector.
On your point there, Steve, there is a great story told by an insolvency practitioner we all know and love, where he was contacted by, I think it was a solicitor referring their director client, and this IP looked over and said, yep, I can act, but it looks like there might be a claim against your client, so we'd have to be careful of that. Met the client, explained the problem, and said, I really do think that if I get appointed, I'm going to have to sue you if you don't repay this money. Goes to a creditors meeting, one of the creditors complains, and the IP says, yes, I hear your complaint, and if I'm appointed, I will look into this, and if necessary, I will sue. And then eventually gets appointed, does the investigation, issues the action against the director, at which point the referring solicitor rings up and says, what are you doing? As if there hadn't been clear marking all the way down. And so I suppose you get into that point of how honest you have to be as an IP. Do you telegraph it from the front, potentially knowing that they will go somewhere else where it might not be? Or do you perhaps not mention it, hope it doesn't come up, and then deal with it once you're appointed? Within that humorous story, there's quite an ethical tale to unpick.
Well, allied to that, if we're going to descend into war stories, apart from all the cases where I see my own name in the director's records as someone to avoid being the liquidator, there's certainly the practice which comes and goes where there is a CVL entered into, and then when it comes to the creditor's vote, it's clear that someone else is going to be appointed liquidator, and so the director chooses not to put the company into liquidation, anything rather than have someone else other than their appointed liquidator. And I think as we're broadcasting this, I think it's fair to unpack that a little bit. What that sends the message is that not only does the director feel that there's something to hide, but they also feel that their nominated insolvency practitioner has already agreed not to pursue them for it. And there is no way that the director worked this out on themselves that they can actually stop the process halfway through. So the convening insolvency practitioner has told the director that they can do this if their suggestion of their favoured IP does not go through. There's a lot to be investigated about that sort of practice. The first person I saw do it, and there was a spate of these across the Midlands, is currently facing charges of fraud and is an ex-insolvency practitioner and bankrupt. So I would say to any IP thinking of advising a director that they can change the process if they don't get their nominated IP, is they should think very, very hard about what message that sends to the other IPs and to their own regulator. But enough of that. Should we end there? Has that been a reasonable exercise of some of the issues?
I didn't even get a chance to go onto the statutory fee report on CVLs and how that was all formed. We'll have to save that for another time.
It would sound terrible if we punched you to death for doing that, Frank. So I think that's probably that would test our microphone qualities to the limit. Jane's been fairly quiet throughout because Jane, of course, doesn't do CVLs. Jane's really a bit of a stranger to this entire market. So, Jane, I don't know if you've got any thoughts based on what you've heard. I don't know if you want to attempt to sum up for us. Is there anything you'd want to sort of conclude? Any surprises from what we've said?
Yeah, well, as the person on this podcast with the least experience in private practice at an IP firm, it has been interesting to hear the different business models operated across the profession. There are similarities with the legal profession, but I think what's quite telling, which you've just touched on, is it's almost like the IP is being pulled in two directions, which of course a solicitor usually isn't. They have one client and they know which way they're going. It doesn't change halfway through because we find a new claim or something. So that I find that quite interesting. But yeah, I honestly didn't realise how many different kinds of sort of ways to practice there were. For example, Joe, you touched on the factories, if you like, where there are hardly any investigations, and then you have other firms that are, huge brands that they have niche tax investigation practices. So that's a good takeaway for me. I'm just wondering about regulation, because it seems to be that some IPs are regulated and some are not. And again, that's quite a revelation as a lawyer, where the law profession is heavily regulated by the SRA, and yet the IP or the insolvency world is only partly. So interesting points there. And I will be interested just to touch on the AI conversation, which I'm sure we will have a different podcast on that. I think that is going to change things massively in the coming years for all of us.
Okay, well, thank you very much, Jane, and thank you to everybody really for your contributions. Next week, we hope to be broadcasting from Edinburgh and talking about Scottish insolvency and the issues there, and hopefully also winning the quiz for the third year running, I think. I've quite a lot of pressure on myself. Obviously, this is insolvency, so the things you plan one week don't necessarily happen the following week, so we can only hope. But I hope you've enjoyed our first episode, and we'll try and say something interesting and entertaining next week. Thank you.